Okay, investors, this week we're going back to a topic we've talked about for the past year. It's an AI bubble. If you've been watching many financial media outlets the last few years, you've been hearing that declaration and opinion often stated as fact. Investment team at Oak Harvest has been asked this question for well over 18 months now. Are we reliving the dot-com capex boom, internet and mobile phone build-out of 1997 through 2000, and the AI investment cycle that started late 2023 with the release of ChatGPT, or is this something new and different? But here's the question I've asked for over a year. If it's such an obvious bubble, and so many pros are so good at spotting bubbles in advance, why are so many in the public markets, equity professionals, still cautious? I mean, why aren't they all in like 1999? That disconnect is where the story really lies. We compare the dot-com stall in the summer of 1999, then the surge in 2000, and today's AI acceleration into 2026. Think of both as a seventh inning stretch. Business momentum was strong, but the stock markets paused for 4 to 6 months before re-accelerating up. So looking at the capex comparison, in 1999, companies were racing to build the internet. Back then, it was fiber networks, telco infrastructure, and eventually the mobile internet. Massive capacity was being built, but it was ahead of real demand. It was ahead of Amazon, it was ahead of Netflix, and ahead of streaming services, and ahead of most mobile telephone applications we use today. That summer, mid-1999, was the seventh inning stretch. The real excess in public equity markets came after that. It came in the 6 months during the fourth quarter, 1999, into late March, first quarter 2000, as the spending plowed ahead of end demand. In many ways, today does look eerily similar to that period in late 1999, but it's fundamentally different. We're 3 years into AI spending, 3 years from the launch of ChatGPT, November 30th, 2022, and usage is exploding from already high level and high growth rates. It's an acceleration driven by real existing usage and demand for compute. For systems driven by NVIDIA and other semiconductor chips, today end demand is exploding exponentially thanks to open source AI programs and agentic agents coming on the scene early February of this year with OpenClaw. What changed in the first quarter of this year that many investors didn't see until just now, just as we exit the seventh inning stretch? The parabolic AI chat growth in 2023 to 2025 has recently went exponential in the first quarter of this year. This was a tipping point beyond the vibe coding moment last year in 2025. AI is no longer just a tool. It's becoming agentic. So what does that mean? AI is now agentic acting, deciding, executing. Systems that act on their own. They run queries, they make decisions, they give suggestions, and they execute tasks automatically 24 hours a day, 7 days a week, every day of the year if needed. That drives real end demand and revenue. It's not build it in hope, but rather build it because current capacity is already overloaded and strained. This drives the price of compute up and GPU values up as well, not down, as Michael Burry had postulated in his short thesis about 6 months ago. So investors, what's kind of different in this cycle? It's private versus public market capital. Now, this is an important difference and one many investors miss. In 1999, capital flowed through public markets. IPOs surged, speculation spread quickly, and retail investors carried much of the risk. In 2026, the most important AI companies are still private. OpenAI, Anthropic, ByteDance in China, SpaceX in another area of tech. Funding comes from large institutions, strategic partners, and other big tech platforms, not from retail investors, Morgan Stanley, or Goldman Sachs. So the structure is different. Back in 1999, the risk was largely public. We had an IPO boom and public speculation ran rampant. Today, OpenAI and Anthropic are still private. Much of the risk is still privately held. That doesn't remove risk, but it changes where it sits. Risk currently is more contained. So looking at the returns, let's cover the returns during the 2 time periods. Here's a table of the S&P 500, NASDAQ, and the SOX indexes from long-term capital low in 1998 in October into the end of dot-com 18 months later. Dot-com S&P up 52% then, NASDAQ up 184%, and the semiconductor SOX index up a whopping 478%. And here's the 13-month period from the same time period from the low to where we stand today, almost 13 months out. Back then, the S&P was up 41%, the NASDAQ up 112, and the stocks had doubled and up 224%. So if we follow our recent 12.5-month returns since the tariff tantrum lows last April, what do the returns look like? Kind of similar. S&P 500 up 42.8%, NASDAQ up 60%, a lot less than the .com, and the stocks up 176%. In 1999, everything in the NASDAQ melted up. Pre-revenue companies, eyeball companies, click companies, anything with a sniff of .com in its name. Today, the markets are a bit more selective. They're strong, but software stocks have lagged for 12 months, as have many of the Mag 7 prior leaders. The strength has largely been in picks and shovels, as Charles likes to say, semiconductors, optics, and infrastructure builders. What's the economic backdrop? Well, now what did the economy look back in 1999? Economic growth was strong. The Federal Reserve was actually tightening interest rates, but it was also creating a special liquidity and event of potential Y2K disruptions in 1999 and 2000. Today, growth is steady and possible about to accelerate into the second through fourth quarter. Inflation was about to peak around 3.5% and come down. We got hit by the Iran war, so right now, inflation is very unclear. As far as the market's behavior, financial markets are concerned, they do look familiar. In both periods, leadership was technology companies, but energy, material, and infrastructure stocks also did very well. But here's a key distinction. In 1999 stock market bubble, many companies had no earnings, traded at multiples of revenue or eyeballs, and if they did have earnings, they traded at 50 to 100 times earnings. See the valuation of Cisco back in the day and compare it to NVIDIA nowadays. Many valuations back then were based on hype and hope. Today, market leaders are highly profitable, generating real cash flow, and seeing earnings reaccelerate with AI demand. Yes, I have to admit, many are now negative free cash flow given their huge capex spends and moving from asset light to more asset heavy. That is a major change, and that is the risk. The risk today is not no earnings. The risk is paying too much for very good current earnings and uncertain future earnings and marginal return on invested capital. So investors, let's assume we're in a similar bubble for the sake of an argument. So where are we right now? A return to our much shared S&P 500 overlay. Here's the updated chart. Remember, no guarantees. Investors, we look to be exiting the seventh inning stretch where upside remains, although risks are rising. So investors, while this is not 1999, we are rhyming a lot with it. The foundation of the AI capex cycle, profits, and existing demand is much stronger today, and valuations are much lower. That's a good thing, and begs the question, why so many have been calling bubbles for not just a few months, but for a number of years? Investors, while we are not early in an economic expansion, due to an agentic tipping point, we have likely just entered and re-entered the reacceleration phase, which should be good for many stocks. Today, the structure of risk is different. 1999, it was public markets and widespread. Today, much of it remains in private markets and concentrated. Maybe the bubble is in private markets this cycle, not in public markets. Investors, we know history doesn't exactly repeat, but given humans repeat many past behaviors in studying behavioral finance, it often rhymes. Right now, we continue to see echoes of 1999, but with a stronger foundation underneath and just exiting the seventh inning stretch. Stay disciplined, stay diversified, and focus on what's real, not what's just exciting. Whether your priority is growth, income, or a combination of both, our team here at Oak Harvest is here to help you plan for your family's financial future, no matter where you're at in your career or in your retirement journey.